everyone. Today we're going to talk about Chapter 14, the cost of capital. In this chapter, we're going to show you how to calculate the cost of equity capital and then the cost of the bond or the fixed income securities. Combining both of them together, we're going to calculate the weighted average cost of capital, which is the WACC. So where we are now. In the previous chapters, I showed you how to calculate the net present value, how to calculate the internal rates of return, how to calculate payback periods, etc. The most important one is the net present value. So when we look at the formula here, in the previous chapters, I asked you to calculate the net present value, and I will give you all the future cash flows and the discount rate, or the required rates of return. But in the real life, no one is going to give you that number for the discount rate. So discount rate for the net present value R here has to be calculated all by yourself or estimate all by yourself. In this chapter, what we're going to do is we are going to estimate the discount rate to calculate net present value. So discount rate here is the weighted average cost of capital we are going to calculate. So first of all, what is required return? We always say required return. It is the discount rate we used in our net present value formula. Okay, so how do we calculate the required rates of return? So first of all, let's take a look at the required rates of return for the equity capital when you issue new equities. If you look at the picture here, the company with excess cash can have two options. One is to pay cash dividends to the shareholders. Once the shareholder receives the cash dividends, they can invest the cash dividends in any financial asset they want. The second option the company has is, instead of paying cash dividends, the company can reinvest the excess cash in more projects. Either way, either paying cash dividends or use the cash to invest in new projects within the company, two options will achieve at the same shareholders' terminal value, right? So here, the shareholders, the owners of the company, have two choices. One is to receive cash dividends, then using the dividends to invest in financial assets somewhere else, or keep the cash within the company and invest in a new project. Which one they prefer depends on which one will yield at a higher terminal value. If the company has a super good project to invest, which can yield a really high return, the shareholders will prefer to use the excess cash invest in the project within the company. If the company doesn't have enough good projects, the shareholders will prefer cash dividends so that they receive the cash and invest the cash somewhere else. So that is like the opportunity cost of capital idea. So the shareholders can reinvest the dividends in risky financial assets, this option, or they can invest the excess cash within the company, which means the return in those projects or the required rates of return in those projects have to be at least as good as the return in other financial assets. So that is the required rates of return, means, for example, 10%. If you invest the cash dividends in another company's stock and getting 10% of the return, that is like your opportunity cost, which means the project within the company needs to give you at least 10% of the return. It will be indifferent between the two. Only if the company will give you, say, higher than 10% return, 11% return in the projects, you will prefer to reinvest the excess cash within the company in the new project. If the project can only give you 8% return, you would actually prefer to receive the cash dividends and invest the cash dividends in other financial assets earning 10% of the return. Okay, so here is the idea of the cost of equity, or the required rate of return for the equity capital. Means you need to give at least the opportunity cost to the shareholders. Okay, so cost of equity or cost of stocks. So the cost of equity is the return required by the equity investors given the risk of the cash flow from the firm. So here the risk means either business risk or financial risk or the combined risk. There are two ways to calculate the cost of a capital. Both of them are studied in the previous chapter, so here this is just a very quick review. You can either use the dividend discount model to calculate the cost of equity, or you can use the campaign model to calculate the cost of equity. Let's take a closer look. So the cost of equity, method 1, use the campaign model. Recall our formula for the campaign model. The cost of equity, or the required rate of return, is determined by the risk-free rates plus beta of the company multiplied by the market risk premium. You can think about S&P 500 as the proxy for the market return. So to estimate the cost of equity capital, all we need to gather is the information about T-bill rates, risk-free rates, company's beta, S&P 500, market risk premium. Most of the time the beta is given, but if you want to calculate your own beta, this is the formula. Okay, so here we have a very simple example. Now we have a stock here, beta 2.5, the company is 100% equity financed. Risk-free rate is 5%, market risk premium 10%. Okay, so what is the required rate of capital, equity capital for this company? Plugging all the numbers in our campaign model, 5% risk-free rates plus 2.5 beta times 10% market risk premium. Cost of equity is 30%, means the company needs to yield at least 30% in the new project. So the required rate of return for the equity capital is 30%. The second way to calculate the cost of equity is from the dividend discount model. Again, a very quick review of the dividend discount model from our previous example. If you rearrange the formula, we can actually get the required rate of return for the equity is going to be the dividend yield plus the growth rate. Okay, for example, if the company stock is $45, expected to pay, or the D1 is $2, and the growth rate of the dividends is constant 9%. Plugging in all the three numbers in this formula, the required rate of return on the equity capital is 13%. Okay, so now you have two ways to calculate required rate of return for the equity capital. One is dividend discount model, another one is the campaign model. Which one is better? Which one should you use? Well, first of all, both of them are internally consistent models. Most companies will use both models to calculate the required rate of return for the equity capital. But from the academic side, we prefer the campaign model over the dividend discount model because, first of all, the campaign model beta explicitly adjusts for risk, the market risk. And also, not every single company pays dividends. While for companies that do not pay any dividends at all, they cannot use dividend discount model, but every single company can use campaign model. So here I summarized the advantages and the disadvantages of dividend discount model. Advantage is it's very easy to understand and use. Disadvantage is, again, as I mentioned before, only the companies who currently paying dividends can use the dividend discount model. A lot of the companies that do not pay any dividends at all cannot use this model. And also, if the dividends is not growing at a reasonable constant rates, for example, the startup, smaller companies, which is still in the fast growing stage, you can't really use this model. And also, this model is extremely sensitive to the estimation of the growth rate, because basically, approximately a 1% increase in the growth rate will lead to a 1% increase in the cost of equity. And it doesn't explicitly consider the market risk. Well, to summarize the advantages and disadvantages of the campaign model, advantages is explicitly adjusted for the systematic or the market risk, and another one is every single company can use it. Disadvantage is because you have to estimate a lot of numbers. First of all, you need to estimate expected market risk, which can vary over time, depending on which time period you're looking at. You also have to estimate beta, which also varies over time, depending on which time period you're looking at. So here we are using the past to predict the future, which is not always reliable, because when you're using the campaign model, all the numbers, the beta, the market risk premium, are the past numbers. We're using the past numbers and thinking the history will repeat itself, but it may not. Okay, so here is an example of the cost of equity. Now suppose our company has a beta of 1.5, market risk premium 9%, risk-free rate 6%. And we also have the following informations. We estimate the dividend will grow at 6% a year, and our last dividend was $2. Pay attention to the wording here. Last dividend was $2. That is our D0. Our stock is currently selling for $15.65. What is the cost of equity? Here we can use both models to calculate the cost of equity. Using the campaign model, we plug in all the numbers. Risk-free rates 6%, 1.5 beta, 9% market risk premium. The required rate of return or the cost of equity is 19.5%. Using the dividend discount model, first of all, we need to calculate D1, which is D0 times 1 plus 6% growth rate, divided by the market price of the stock, which is $16.65, plus the growth rate, constant growth rate of 6%. We get 16.55%. So in this example, using both models gave you pretty much the same answers. But in real life, most of the time, using both models will give you two different numbers. Which number should you use? Well, this is more a very subjective question. Different financial managers may pick different numbers to use. Again, campaign model is more general. All the companies can use the campaign model number. Dividend model number is extremely sensitive to the estimate of the growth rate, which is 6% right here. So as to which number to use is a very subjective question, and in real life, you need to consider a lot of factors, and you have to give some weights to which model you want to use. There is no single right answer to that question. Okay, so when you are doing capital budgeting and think about the risk, you have to think about the company's overall risk, but also have to consider the individual project risk. In the following example, let's take a look. Now suppose the company has a cost of capital based on the campaign model of 17%. Risk-free rate is 4%. Overall company's beta is 1.3 times market risk premium of 10%. Okay, so the company's overall beta is 1.3. But there is a breakdown of the company's investment projects. The companies invest in 3 completely different areas. 1/3 of the projects are in the automobile retailer industry. The beta is very high, 2. 1/3 of the investment projects are in the computer hardware industry. Beta is 1.3. 1/3 of the projects are in electric utility. Beta is only 0.6. So the overall average beta of all the assets is 1.3, which is 2 plus 1.3 plus 0.6 divided by 3, which is 1.3, which is also the risk of the overall company's beta 1.3. But when you are looking at a new electrical generation investment, which falls in this category, instead of using the 1.3 overall beta, you should consider 0.6 beta to evaluate this particular project. Okay, so to summarize, to calculate the cost of equity, you can use either campaign model or the dividend discount model. Then we move on to the cost of debt, because a lot of the companies are not 100% equity form. Their capital structure is a mixture of equity and long-term debt. So let's take a look at how do we calculate the cost of debt. So the cost of debt is the required rates on our company's debt, which is very simple, the yield to the maturity. Remember, in our previous chapters, we calculate the cost of debt or the price of the debt. The price of the debt is going to be the present value of all coupon payments plus the final face value or the par value payback. Look at the discount rate in this formula, the R here. This is the yield to maturity, and the yield to maturity is our cost of debt. Okay, so when you calculate the cost of debt, all you need to do is to calculate the yield of maturity of that bond. So basically in this chapter we don't really have anything new. It's just a review of all the knowledge we learned before and connecting all of them together. Okay, take this for example. 25 years maturity, coupon rate 9%, paid semi-annually, face value $1,000, current price $908. What is the cost of debt? Plug in all the numbers in the formula or in the financial calculator. Because this is a semi-annual payment bond, so the total number of periods, 50 periods. Payment per period. The coupon rate is 9%. Each year you have $90, so half a year you have $45. Future value or the face value of the bond is $1,000. Present value or the price of the bond is $908. Because this is the money you paid for the bond, so that is cash outflow. You need to put a negative number in front of it. Compute the yield to maturity. The computer will report 5%, but you know that 5% is for 6-month period, and we need to annualize that number by multiplying 2. So the yield to maturity or the cost of debt is 10%. So finally, we want to calculate the cost of preferred stocks because some companies also issue preferred stocks. The preferred stocks are different from the common stocks because preferred stocks will pay you a fixed amount of dividend forever, which is a perfect example of the perpetuity. So remember the price of the preferred stock, which is the P divided by D over R. When we remove move the R to the left-hand side. So the required rate of return for the preferred stock is just the dividend divided by the current stock price. So the company has preferred stock pays annual dividends of $3. The current price is $25. What is the cost of the preferred stocks? Simple. Plug in the numbers. The preferred stock cost is 3/25, 12%. Okay, so now we have all the ingredients of the weighted average cost of capital. Let's put them together. So the weighted average cost of capital, or the WACC, is the average cost of the capital for the company when the company issue both stocks and bonds. Their cost of asset is going to be a weighted average of bonds and stocks. If the company issues bonds, stocks, and preferred stocks, then the average cost of asset will be the average cost of bond, stock, preferred stocks. So when people say stocks, they refer to common stocks. Most of the time, they do not say common stocks. They will just say stocks. When they refer to preferred stocks, they will say preferred stocks. If they just simply say stocks, means common stocks. Okay. So before I introduce the formulas, I want to introduce some notations. Capital E means the market value of the equity, or the market value of stocks, which is the number of shares outstanding times the price per share. Capital D is the total market value of the debt, which is the total market price of the bond, not the face value of the bond. Capital V is the total market value of the firm, which is the sum of the debt and equity. Okay, weights. The percentage financed by the equity, which is equity divided by the total value of the firm. The percentage financed by debt is the market value of debt over the total market value of the firm. Okay, so let me emphasize the market value here. When we talk about capital E and capital D, we do not use the book value recorded in the accounting book in the financial statements. No, we are going to calculate the market value of stocks and bond. Okay, so the market value of the bond is the present value of all coupon payments and par value discounted at the yield to maturity. Basically, you need to calculate the price of the bond. Market value of the equity is the market price per share multiplied by the total number of shares of outstanding. Here are some examples. If the company's bonds pays 5% coupon, 3 years maturity, 7% yield to maturity, face value $1,000. So the face value $1,000 is not the market value of the bond. To calculate the market value of the bond, we need to use all the numbers to calculate the market price of the bond, which is the discounted value of all coupon payments face value at the 7% yield to maturity. So the price of this bond is $947. Therefore, we're going to use this $947 as the market value of the bond to calculate the WACC, not the face value. Okay, now finally I can present the formula for the weighted average cost of capital. So the WACC is the proportion of the debt times 1 minus the corporate tax rate times the cost of debt, which is the yield to maturity of the bond. Why do we have a 1 minus tax rate here? Because the interest payment or the coupon payment is considered as business expense, and the business expense is tax deductible, which means we can save the tax payments on the coupon payments. The proportion of the equity, so E over the total value of the firm, times the cost of equity. Whenever we say equity or stock, we refer to common stocks. So R, or the cost of equity, the cost of common stocks, can be calculated by either dividend discount model or the campaign model, as we showed in the previous slides. the proportion of the preferred stocks, P, over the total value of the company times the preferred stock cost, which is very simple. According to the perpetuity formula, this is just D divided by P, as we showed in the previous slides. Okay. All right. So the dividends of the common stocks and the dividends of the preferred stocks, those payments are not considered as business expense. So there is no tax benefits. There is no 1 minus corporate tax rate in the stocks or the common or the preferred stocks. Okay, so let's put everything together to calculate the work. Now we have a company, $8 million in bond, $50 million common stocks. Both numbers are market value. $5 million worth of outstanding preferred stocks, market value. Required rates of return for the three assets, 8, 12, 10% respectively. 35% tax rate. What is the weighted average cost of capital for the company? So the first step is we need to calculate the total weights for each component. Luckily, in this question, those numbers are given. $8 million debt, $15 million equity, $5 million preferred stocks. Excuse me. So the total value is going to be the sum of all the three assets, $28 million. Cost of debt, 8%. Cost of equity or cost of common stocks, 12%. Cost of preferred stocks, 10%. Plugging in all the numbers in our work, the ratio of the debt, 8 divided by 28 times 1 minus 35% corporate tax rate times cost of debt, 8%, plus portion of the equity, 15 over 28, times the cost of equity, 12%, plus portion of the preferred stocks, 5 over 28, multiplied by 10% cost of preferred stocks. Okay? Add them up. The weighted average cost of capital is 9.7%. Okay. Let's take a look at another example. For the following company, we gather the information on the equity, means common stocks. We also gather the information on debt. 50 million shares outstanding, each share $80, beta 1.15, market risk premium 9%, risk-free rate 5%. Debt, face value $1 billion. Current quote, which is the price, 110 means 110% of the face value. Coupon rate 9%. Semi-annual coupon payments, 15 years to maturity. Tax rate 40%. Let's calculate the work for that company. So first of all, what is the cost of equity? We're going to use the campaign model, 5% risk-free rates plus 1.15 beta times market risk premium. So the cost of equity or the cost of common stock, 15%. What is the cost of debt? Well, using the numbers given, number of periods, 15 years, multiplied by 2, 30 periods. Price, 110% of the face value, which is $1,100, because the price is the money you paid, so there is a negative sign in front of it. Payment per period, $45 per 6 months. Face value, $1,000. You compute the yield to maturity over the 6-month period, 3.92. Annualize the number by multiply the 6-month number by 2. 7.8% is the total cost of debt. So what is the after-tax cost of debt? Well, the tax rate is 40%. So 1 minus 40% times the cost of debt. 4.7% is the after-tax cost of debt. So here, we calculate the cost of equity and the after-tax cost of debt. The next step, we're going to calculate the capital structure, which is the weight of the equity and the debt. The total market value of the equity is 50 million shares outstanding times $80 per share, so totally $5 billion. Debt, $1 billion face value times 1.1, which is 110% price, which is premium of the face value. So the total market value of the bond is $1.1 billion. Total value of the company will be the sum of the two numbers, $5.1 billion. The weight will be the ratio. What is the weighted average cost of capital? Plug in all the numbers we calculated before. The ratio of the weight of the equity times the cost of equity plus the weight of the debt times the after-tax cost of debt. The weighted average cost of capital is 13.06%. Okay, now we have another example, international paper. Now suppose we have beta 0.82, risk-free rate 3%, market risk premium 8.4%. So the cost of equity is, obviously we're going to use the campaign model, which is 3% risk-free rates plus beta times the market risk premium. So the cost of equity is 9.89%. The company also issue debt. The cost of debt or the yield on the debt is 8%, 37% marginal tax rate. The debt to value ratio is 32%. What is the WACC? Well, the WACC will be the weight of the stock times the cost of stock plus the weight of the bond times the cost of the bond multiplied by 1 minus the tax rate. We're going to calculate after-tax cost of the debt. Okay, plug in the numbers. So the debt to value ratio is 32%, means the equity ratio is 68%. Debt ratio or the bond ratio 32%. Okay, in the previous slides, we calculate the cost of equity is 9.89%. And in this page, the cost of debt is 8% times 1 minus 37% tax rate. We get 8.34% WACC. Okay, so 8.34% is the cost of capital or the overall cost of capital for international paper. When you're considering any project to do in this company, this WACC, 8.34%, is going to be the discount rate you are going to use. Now suppose the company is considering to take on a new project. The project will cost $60 million, and each year it will generate cash flow of $12 million for 6 years. So the question says each year it can save $12 million. If you can save $12 million, which is equivalent to a $12 million cash inflow, right? So will the company take the renovation or not? What should we do? We should calculate the net present value, right? So why don't you stop the video here, pause it, calculate the net present value. Using the WACC we calculated in the previous slides as the discount rate. Initial cost, $60 million. So C0 is minus $60 million. Time period, 6 years. Each year, the cash flow is $12 million. Plugging in all those numbers in the financial calculator and calculate the net present value. The net present value is -$5 million, which means you should not take the projects. So in this question, I showed you why we need to calculate the WACC, because WACC is the discount rate R we used in the net present value calculation. In previous chapters, I always tell you the discount rate to calculate the net present value, but in real life, no one is going to tell you the R. No one is going to tell you the discount rate. You have to calculate the discount rate all by yourself by calculating the WACC. Okay, at the end of this chapter, again, I presented a couple of multiple choice questions. What should you do is, you solve the question independently. Pause the video here and then check the answers. All the 3 multiple choice questions are direct plug-in questions, plug-in number questions, so there's really nothing to explain. Just try to do it yourself independently and then you checked it. Okay, pause the video here, then check the answer. Pause the video here, independently solve it, and then check. So that's the end of this chapter. If you have any questions, please email